Successfully navigating the EB-5 Immigrant Investor Program involves more than just securing a green card. It requires a clear understanding of how to retrieve your principal investment. This section details the primary exit strategies available to investors once their project fulfills the job creation requirements and the required holding period has passed. The EB-5 investment must remain at risk for a minimum of 2 years, or until the I-829 petition is adjudicated, whichever comes first. Successful exit planning begins before the initial capital commitment. 2-year minimum. The initial capital must be maintained in the NCE for at least 24 months. Job creation threshold. The project must demonstrate the creation or preservation of 10 full-time jobs per investor. I-829. Adjudication. Final approval of the I-829 petition is the critical step that confirms eligibility for permanent residency and often triggers the repayment process. The method by which capital is returned is dictated by the underlying business structure and the terms outlined in the private placement memorandum. In many EB-5 structures, the investor's capital is treated as a loan to the regional center or the NCE. This is often the most predictable exit route. Upon project completion or maturity date specified in the loan agreement, the NCE repays the principal amount to the fund. The fund then distributes the capital back to the individual investors. Note: interest payments, if applicable, are generally treated separately from the principal repayment and do not affect the at-risk status of the principal investment. When the investment is structured as equity, the return of capital is tied to the success and eventual sale of the underlying asset or enterprise. Asset sale. The NCE sells the developed property or business to a third party. The proceeds are distributed according to the priority waterfall defined in the operating agreement. Refinancing. A new lender provides senior debt to pay off the EB-5 capital stack. This is common in real estate when the asset has appreciated sufficiently. Recapitalization. The company takes on new non-EB-5 equity to buy out the EB-5 investors. While the goal is a timely return, several factors can delay or jeopardize the exit. Project delays. Construction delays, permitting issues, or unforeseen economic downturns can postpone the asset sale or maturity date, keeping the capital tied up longer. Failure to meet projections. If the business underperforms, it may lack the cash flow necessary for loan repayment or the valuation required for a favorable equity sale. Regulatory uncertainty. Changes in USCIS interpretation or processing times for the I-829 petition can inadvertently delay the contractual exit window. Investors should closely examine the priority waterfall in their PPM, which dictates the order in which parties receive distributions upon sale or refinancing. The EB-5 investors are typically subordinate to senior lenders. A prudent EB-5 investor treats the exit strategy with the same rigor as the initial project selection. Ensure the PPM clearly defines the maturity date, the repayment mechanism, and the remedies available if the project defaults on its obligations.
Proactive communication with the regional center regarding project milestones is essential for managing expectations surrounding the eventual return of your capital.